In just 7 trading sessions, silver-linked ETFs were reported to tumble 38% from a late January peak, after silver itself whipped from the 120s down toward the $60 zone. Not months, not weeks. And yet it did. Now here's the part most people miss. When a market moves that fast, price is rarely the first story. Price is the headline. The first story is always the plumbing, collateral, leverage, margin, settlement. The quiet rules that decide who gets to stay in the game when volatility stops being theoretical. Because while the public sees a chart, institutions see a stress test. They see who is forced to post more cash, who is forced to reduce exposure, and who is quietly positioned to absorb what gets dumped. The gap between those two perspectives is the gap between reacting and understanding. And what I'm about to reveal changes how you read this entire silver episode. Not as a random spike and crash, but as a system response, a reset mechanism, a transfer. Welcome to Channel Name, where we decode what matters before it becomes headlines. No theatrics, no doom. Just the mechanics that shape outcomes. If you like analysis that treats the audience like adults, consider subscribing the way you'd keep listening to that wise elder who always seems to notice the important detail first. And drop a comment telling me where you're watching from, because this community spans more time zones than most trading desks. Now let's reconstruct what happened, with forensic precision. Late January saw a surge that looked less like a normal commodity rally and more like a scramble. Prices accelerated into triple digits, and then, almost immediately, the air got thinner. In the background, the exchange that hosts the most important paper silver contract did something that matters far more than most headlines. It changed the cost of carrying risk. On February 6th, 2026, the CME confirmed that it raised initial and maintenance margin requirements for COMEX 5,000-ounce silver futures to 18% from 15%, effective after that day's close. That sounds like a small adjustment, 3 percentage points. But in leveraged markets, 3 points is not 3 points. It's a signal, and it's a force. And it wasn't a one-off. That increase followed earlier increases on January 30th and February 2. And even before those, on January 13th, CME moved to percentage-based margining for gold and silver futures, tying required collateral more directly to the market's own volatility. In plain terms, the faster price swings, the more cash the system demands, not later, now. So while the crowd was watching price surge, the system was preparing a squeeze on leverage. That is not conspiracy, that is protocol. It is what exchanges do when volatility threatens clearing stability. But it has consequences. Because when margins rise quickly, the market doesn't ask whether you're right about the long-term story. The market asks whether you can post cash tonight. If you can, you stay. If you can't, you reduce. And if enough participants reduce at once, the price can fall regardless of what should happen. That's why silver can do what it just did. Explode upward on enthusiasm and tightness, then collapse on collateral calls, all while the deeper physical story remains unresolved. To understand why that matters, you have to recognize the pattern. This is not the first time silver has played out as a collision between paper leverage and physical reality. In 1980, silver ran as a story of scarcity, inflation, and concentrated positioning. The result was not a gentle reversal. It was a break driven by changing terms of participation and forced liquidation. In 2011, silver ran again into a vertical phase. And then the leverage terms changed and the air came out. Different decade, same playbook. In 2026, we've watched the same sequence. Acceleration, strain, rule tightening, liquidation. This doesn't mean history repeats perfectly. It means markets rhyme in mechanics. And when the mechanics line up, you pay attention. Now, let's name the players, because the market is not a single mind. It's a set of institutions with different roles. The CME is the venue. It is not a bank taking directional bets. It's the infrastructure that must ensure contracts can clear. The clearinghouse sits at the center, making sure that if one side fails, the system doesn't collapse. That's why margin is sacred. Margin is the buffer. Banks and brokers are the conduits. They extend credit lines, they manage client risk, they decide how much leverage a client can access and at what cost. When exchange margins rise, brokers often raise their own house margins even more because they don't want to eat losses if a client can't meet a call. That's how exchange changes propagate into the real world faster than headlines do. Funds are the accelerants. Some are long-term, some are trend-following, some are arbitrage-driven. In a volatility spike, their models can flip from add to reduce within hours. The same strategy that amplified the move up can amplify the move down when signals change. And then there's the physical complex. Refiners, mints, industrial users, wholesalers, vault operators, and the investors who demand delivery or allocate metal into storage products. They don't always care about a one-week price shock. They care about sourcing, premiums, lead times, and inventory. That sets up the dislocation. 2 markets, 1 metal, opposite signals. In the paper market, price is immediate and leverage is elastic. You can control a large notional position with a fraction of collateral until the rules change. In the physical market, you can't print bars. You can't settle a refinery outage with a spreadsheet. You either have metal or you don't. And this is where the data becomes uncomfortably specific. A February 2026 outlook from the Silver Institute projected a sixth consecutive annual silver market deficit in 2026, estimated around 67 million ounces. 31 billion ounces, and forecast physical investment rising about 20% to roughly 227 million ounces. Read that slowly. A multi-year deficit environment, large existing stock held in products, and rising physical demand. Now overlay that with exchange-driven deleveraging. It creates a scenario where paper price can fall hard, even while the longer-term balance remains tight, because the marginal seller in the moment is not a miner or a mint. It's a leveraged participant meeting a call. That is why the crash can be the clue rather than the conclusion. Here's where it gets interesting. Exchanges don't raise margins because they want lower prices. They raise margins because volatility threatens the integrity of clearing. But the effect is the same as pouring sand into the gears of leverage. It forces participants to choose between adding cash or cutting exposure. That choice happens under time pressure, and time pressure creates mispricing. Think of it like a crowded theater where the doors suddenly narrow. The seats didn't change, the movie didn't change, but the ability to move changes instantly. The people closest to the exit move first. The people deep inside get compressed, and the ones carrying heavy bags get stuck. Margin hikes are the narrowing doors. When volatility rises and collateral requirements rise, the market's doors become smaller for anyone relying on leverage. That doesn't tell you the story is over. It tells you the system is controlling flow. Now, look at the sequence again. Percentage-based margining on January 13th. Margin hikes on January 30th, February 2, and February 6. And then, reports of silver-related ETFs tumbling 38% in 7 sessions. That is a tight timeline. The institutional system responded quickly. That's what systems do. But if the system is tightening leverage, why did the price surge in the first place? Because there were two forces. One was narrative-driven demand, inflation hedging, uncertainty, and the evergreen appeal of precious metals when trust in paper assets feels fragile. The other was structural. The physical market's ability to meet rising investment demand without creating obvious stress is not unlimited, especially when industrial demand is also part of the equation. It's also a critical industrial input. It lives in electronics, solar, medical applications, and countless components that don't make headlines. That dual identity means the market can appear calm until it suddenly isn't. A small change in investment demand can collide with steady industrial needs and create a squeeze. But then leverage arrives. Paper claims multiply, price rises, momentum strategies join, options flows magnify. And at a certain point, the system has to ask, can all of this risk clear if the market swings another 10% tomorrow? When the answer becomes, maybe not, margins rise. That's the mechanism. It's not mysterious, it's mechanical. The result is forced selling. Not because the long-term thesis is invalid, but because the short-term cash requirement is absolute. If you have a position and your broker calls, you can't answer with conviction. You answer with dollars. And that forced selling creates an illusion. It makes the market look like it rejected the narrative. But the deeper question is whether the underlying conditions that created the surge have changed, or whether the paper layer was simply wrung out. Historically, this is where silver becomes most informative. In 1980, the unwind taught markets that concentrated exposure and changing participation terms can break even the strongest narrative. In 2011, the post-run collapse taught the same lesson in a modern derivative context. The repeated lesson is that silver doesn't just test sentiment, it tests structure. So what should you watch now if you're trying to understand whether we're seeing a temporary deleveraging or a more lasting regime change? First, watch volatility and margin policy. When an exchange shifts from fixed to percentage-based margining, it embeds an automatic stabilizer that becomes an automatic amplifier during extreme swings. If volatility remains elevated, collateral demands remain elevated. That can cap speculative participation for longer than people expect. Second, watch the relationship between paper price and physical availability indicators. In tight markets, you often see stress show up as higher premiums, longer delivery times, or unusual shifts in inventory behavior. The key is not a single data point, it's persistence. Third, watch the behavior of large pools of metal already held in products. 31 billion ounces, that stock is both a buffer and a pressure point. In a sell-off, some holders might liquidate and release metal, easing physical stress. But in a trust crisis, those holdings can become sticky, and new demand can show up faster than supply can respond. Fourth, watch the deficit itself. A projected deficit of around 67 million ounces is not a rounding error, it's a structural gap. If it persists, the market has to reconcile it through higher prices, reduced demand, increased recycling, new mine supply, or releases from inventories. Those are the only options. The question is which one the system selects and how violently. Now, let's talk about the deeper reset idea implied by the title, because it's easy to drift into empty drama. Resetting the system doesn't have to mean some secret meeting. It can mean something far more mundane and far more powerful. The system reprices, risk, and reallocates who holds exposure, and that forces a redistribution. Participants with shallow liquidity exit. Participants with deep liquidity endure. The metal doesn't change. The ownership profile does. That is why silver is the clue. It sits at the intersection of trust, scarcity, and leverage. It reveals stress earlier than many markets because it is small enough to move and important enough to matter. And when it moves, institutions watch not just the price, but the collateral flows around it. If you want a simple analogy, imagine a dam with two gauges. One gauge measures the water level. The other measures the pressure at the foundation. Most people watch the water level because it's visible. Institutions watch the foundation pressure because that's what decides whether the structure holds. Silver's price is the water level. Margin policy, clearing stability, and physical deficits are the foundation pressure. This latest episode showed a wild water level move. But the foundation data, like a projected multi-year deficit and large but finite above-ground holdings, suggests the pressure hasn't vanished. The system simply tightened rules to prevent a structural failure. So where does that leave forward analysis? Historically, when you see a vertical move followed by rapid margin increases and a sharp retracement, you get one of three broad paths. In a conservative scenario, volatility cools, margins stabilize, and price finds a lower equilibrium while the market digests excess speculation. The story becomes boring for a while. The physical market continues to tighten or loosen quietly in the background. In a moderate scenario, the deleveraging flush creates a base, and price gradually realigns with fundamentals as the market realizes the deficit story didn't disappear just because a leveraged layer got squeezed. This is the slow grind that frustrates both sides because it doesn't reward adrenaline. In an aggressive scenario, the dislocation between paper and physical widens rather than narrows, especially if investment demand remains strong while industrial demand holds. In that case, the next stress point doesn't come from a chart pattern. It comes from sourcing and settlement behavior. Historically, that's when markets reprice quickly again, often after the crowd has declared the story finished. Notice what I'm not doing. I'm not declaring a guaranteed outcome. I'm describing what these mechanics have tended to produce when they appear together. And this is the part no one is discussing. Even if you never touch a futures contract and never care about margins, the margins can still shape the price you see because they shape who can carry exposure. It is supply, demand, and the cost of staying solvent under the rules. That's why the divide matters. Some people will look at the recent plunge and conclude silver was a hype bubble. Others will look at the margin timeline, the deficit projections, and the scale of metal held in products and conclude something else, that the market was temporarily forced to de-risk and that the underlying tension may still be there. It's not about being smarter, it's about knowing what to measure. In every major market episode, institutions move first because they are closer to the plumbing. They get the margin notices before the headlines. They see the liquidity conditions before the commentary. Retail tends to move last because retail is trained to watch price and narrative, not collateral and clearing. That information gap becomes a wealth gap, not because anyone is evil, but because structure rewards those who understand structure. So if this silver episode felt confusing, that's normal. It was a live demonstration of how modern markets can disconnect in the short run from the story people think they're trading. The reset isn't a single event. It's a process, a rapid tightening of risk terms, a forced reduction of leverage, and a quiet transfer of exposure to stronger hands. Silver is the clue because it shows the fingerprints. Percentage-based margining introduced on January 13th. Successive margin hikes on January 30th, February 2, and February 6. A reported 38% ETF tumble in 7 sessions. A projected 2026 deficit around 67 million ounces, 31 billion ounces. Physical investment projected up about 20% to roughly 227 million ounces. When those numbers sit in the same frame, the story stops looking like chaos. It starts looking like a system managing stress. Let's zoom in on the dislocation, because paper versus physical can sound abstract until you see how it behaves. A futures contract is a standardized promise that can be traded in seconds, often by participants who never intend to handle metal. That liquidity is useful, but it also means the paper layer can expand far beyond the daily flow of bars. In calm conditions, that expansion looks like healthy depth. In a volatility shock, it becomes a problem because every promise sits on collateral, and collateral is finite. Physical metal moves to a different tempo. Refiners, transport, fabrication, and vault logistics run on schedules. When investment demand jumps, the system can respond for a while by drawing down inventories, redirecting shipments and widening spreads. It cannot respond instantly the way a screen price can. That timing mismatch is where dislocations are born. Now connect that to the margin timeline. Percentage-based margining is a regime shift because it makes required collateral reflexive. Volatility rises, margin rises. Margin rises, leverage participants face a decision, post more cash or reduce. Reduction can push price down, which can increase volatility again. The system is designed to protect clearing, but the side effect is that deleveraging can become self-reinforcing in the short run. This is why a move from 15% to 18% matters. On a 5,000-ounce contract, a $1 move is $5,000. When silver swings $10 or $20 in a session, that's $50,000 to $100,000 of mark-to-market movement on a single contract. Multiply that across portfolios, and margin stops being a footnote. It becomes the steering wheel. So what should you watch next if you're trying to read whether the reset is still underway? Watch whether margins continue rising or whether they plateau. A plateau often signals volatility is becoming manageable for the clearing system. Continued increases signal the system still sees risk as unstable. Watch open interest alongside volume. In forced de-risking phases, open interest often falls as positions are closed, even if volume stays high from churn. That combination can hint at liquidation rather than a calm change of mind. And watch for persistence in physical tightness indicators. If paper products tied to silver drop sharply while the physical market remains stubborn, that divergence is information. Over time, divergences resolve and the resolution is rarely gentle. A system can reset without a press conference. It can happen through a chain of small rule changes that together redefine who can carry exposure. One more layer completes the picture. How fast narratives flip when the mechanism changes. In 1980, the public memory is the spectacular rise and fall, but the operational lesson was that when the terms of participation tighten, the market can break regardless of how convincing the story sounds. Participants who were positioned with borrowed money learned that borrowed money has a clock on it. In 2011, the chart looked modern, but the rhythm was familiar. A steep climb, then repeated. Increases in the cost of carrying risk, then a wave of liquidation that made it feel like demand had disappeared overnight. That same rhythm is visible now. A fast run invites momentum. Momentum invites leverage. Leverage invites stability questions from the clearing system. And when the clearing system answers with higher margin, the market's personality can change within days. This also helps explain why silver often looks more violent than gold. Silver's market is smaller, its industrial component is larger, and its investor base can be more reactive. That combination makes it easier for speculative positioning to overwhelm near-term liquidity, and easier for forced selling to produce exaggerated downside. The metal becomes a mirror for the financial climate. When funding is easy, silver can levitate. When funding tightens, silver can drop faster than fundamentals suggest. The contradiction is that physical conditions can remain tense while the financial layer is forced to shrink. Once you see that, the recent move stops looking like proof that one side was wrong. It starts looking like a clearing event that reveals where stress lives, that tells you the engine still runs. And that's why the clue isn't the last candle. It's the sequence of rule changes that arrived at exactly the moment the public got most excited. If volatility returns, watch the clearing response first. Price will follow. Institutions read those signals early. The public hears them later, after the move has already happened and the notices no one reads. Watch closely.